Let's cover interest rate versus APRs and what points are. The interest rate determines what the lender charges you to borrow money. The APR, or annual percentage rate, is, to put it simply, the interest rate plus charges and expenses that make up the true cost of financing, including points, origination fee, processing fees, interest, and mortgage insurance. Points are fees paid up front to the lender to lower the interest rates and therefore your monthly payment. The APR is a helpful tool for comparing multiple loan offers with varying costs. Let's look at a couple. These interest rates are exactly the same, but the APRs are different. Why? Each loan comes with different fees, and when you factor these in over the life of the loan, you get the APR. Sometimes the interest rate will be higher than the others, but the APR is lower. That means the upfront costs are actually lower. However, the one with the lower rate actually has a higher APR, which means you'll ultimately pay more over the course of the loan. The APR does have its shortcomings as a method of comparison. Remember, the APR spreads those front-loaded costs over the life of the loan, and there's a good chance you'll move or refinance your loan well before the loan term ends. If that happens, your costs are spread out over a shorter time period, changing your actual APR. Here's an example. Let's say you refinance or sell after 5 years. If you chose Loan 1, then your actual APR changes to 4.407% because those upfront costs are now spread out across 5 years, not 30. Compare that to Loan 2, which had the same rate and a higher APR. On that loan, the true APR is 5% if sold or refinanced after 5 years. But Loan 3's APR is still 3.75% because there were no costs. Overall, the highest rate loan over 5 years actually was more affordable. There's one more spice to add into the mix: points, which, as mentioned earlier, are fees paid upfront to lower your interest rate. The cost of each point is 1% of your loan amount. For example, on $100,000, 1 point would be $1,000. The amount the interest rate goes down by point varies from lender to lender. You should expect a range from 0.125% to 0.25% on a 30-year fixed. In general, points make sense the longer you plan to stay in your home. Think of it this way. If paying $1,000 in points up front would save you $250 a year in mortgage payments, then it will take 4 years to break even, and you'll save $250 a year every year after that. As you shop for lenders, know that the rate reduction you get per point is completely negotiable, and fees associated with points are considered a cost, so they factor into the APR calculations. So that was a lot. Let's sum it all up. As you shop for a loan, make sure to consider the interest rate, the APR, which includes the total costs including fees and points, as well as the time you plan to be in your home. Now go ahead and test out your newfound wisdom. You can easily compare rates, APRs, monthly payments, and lenders' various fees at LendingTree.com.